Hi, good afternoon, everybody. So we are back with the latest edition of Netra, marking the last one for the before the year ends. So lately, there has been a lot of conversation around the constant conviction in the India's growth story. So in today's call, Sahil will present a perspective on where we actually are. Further, there will be some discussion around the equity market's resilience despite an economic slowdown globally and also in the domestic space. So Sahil will take you through all these data points in detail, helping you carve a better picture around these complexities. Also, during the course of the presentation, you guys can put in your questions in the question answer tab on your screens. We will collectively take your questions towards the end of the presentation. Over to you, Sahil.
Thank you. Thanks a lot, Pragati. And good evening, all of you. So I'll be discussing, as Pragati said, the December edition of Netra. I'll share my screen and we'll get going. So we publish it every 5th of the month. As you know, there are links online where you can download it. We made a small correction in this note, which I'll highlight, during the course of my presentation. So three things we'll discuss today: small caps, dedicated 3 slides to it, thinking because I think a lot of investors are flocking towards small caps and focusing on that theme. So we'll talk about it. We'll also talk about India growth and what are the numbers that we are looking at and how to make sense of it. And in the end, we'll talk about a few ideas that we like today and how we are, watching them. So let's start with small caps. And as you can see that the performance for small and mid caps have been exceedingly well this year. They have rallied significantly over the last 11 months. Small and mid cap both have outperformed large caps by a very wide margin. And this is a 1 year CAGR. Earlier, we've corrected it. It was not 2 year, 1 year CAGR of small cap over Nifty. So basically, small caps over large caps. As you can see that the numbers have significantly gone up. That means whenever this blue and black line is going up, the black line is for mid cap outperformance over Nifty or mid cap performance over Nifty, and blue line is small cap index outperformance over Nifty. These are both small cap 100 and mid cap 100 index. So as you can see that they have outperformed significantly in the past when we've seen such outperformance between 10 to 15 to 20% for each small and mid cap. That is the time when their outperformance halts. There have been ranges when they have gone up above 20% also. Small caps are approaching that number. Since we wrote this, they have already gone up slightly more. So this number is slightly higher than when we wrote this. So we've seen that whenever the past outperformance is very, very high, usually we see a reversal where mid and small caps find it very hard to outperform large caps in the upcoming period, right? So that is the key takeaway. This outperformance is also very cyclical. And those of you who have seen this chart before, we highlighted this chart in December 22 when these ratios were here at the lower end. And we had highlighted why small and mid caps make a lot of sense at that point in time. But since then, they have rallied between 50 to 80% depending on which index you take, which segment you take. And they have also become slightly more expensive. So I've put valuations here. And based on the 12-month trailing PE ratio, Nifty is at 21.8. Since I wrote this, Nifty is now above 22 times. Mid cap index is at 31x, again slightly higher now, and small cap is at 23.5, again slightly higher now since the time we wrote. Even in the last 7 days, we've seen stocks slightly higher. So that will also get cooked into these numbers. We wrote it at the end of November, so there are about 12 days of rally cooked into these numbers. And one more important point, as you go along market capitalization, although this Nifty small cap index will not show you that, but when you go from the largest stock, which is the number one stock in terms of market capitalization, to let's say stock number 1000 or 1200, as you go along this market capitalization, stocks are becoming more and more expensive. Smaller stocks are more expensive than larger stocks, and this is something that we've seen happen throughout the universe, and therefore it also makes sense that on not only on price but on valuations also they have accumulated some froth, right? So as I've written here, this opens the room for relative underperformance for small and mid cap, which is SMID, which is the short form for small and mid cap stocks. Second is that if If that is the case, then how to invest in small cap? A lot of people are putting in money into this category. A lot of investors, even people who do direct investing, are picking small and mid caps because returns are excellent, right? We've seen massive CAGR in many of these smaller companies. And mind you, small cap does not mean only small price stocks. Even is not a parameter, right? So stocks which have low market capitalization, that is the point here, whether small or mid cap. But now we are talking about smaller companies, small cap stocks where market capitalization is lower. So we did a study. We looked at what is the best way to invest in small cap now. So one important takeaway that we have is that you should utilize the SIP approach in small caps now, right? It's an often repeated, point, but why is it important now? So we looked at three different data sets. One, starting a SIP when Nifty small cap index has fallen by 20% or more, right? Or starting a SIP when it has rallied 20%, right? From whatever level it was, 1 year, 20% up. And starting a SIP when it was at lifetime high or all time high. And interestingly, when you start a SIP when the market is at all-time high, your 10-year median SIP return is the highest when market is at all-time high. Now, this is slightly counterintuitive. That means if you start a SIP when the market is at all-time high, you make more money than starting a SIP when the markets are down. Let's compare it to real life. Comparing it to, let's say, today, starting a SIP versus starting a SIP when let's say Nifty was at 7,500 during COVID March era, March 2020. Interestingly, people who start a SIP at lifetime high probably would have made more money historically than those who started SIP when the market were at low. What is the reason? The idea is that if you start a SIP and stay through it for the next 5 or 10 years, you accumulate more units when markets fall. Okay. So that is what I've written here. Whenever markets fall from peak, you start to accumulate more units. That means the falling NAVs help you accumulate more units. Second is these higher units will get benefit when the markets turn again. So think about this: when markets are at lifetime high, you start a SIP. The initial few purchases will give you very few units, right? Because markets are high, and let's say your SIP is for 10,000 rupees, it will accumulate only so many units. Let's assume only 2 units, right? But when markets fall, let's say by 20-25%, same 10,000 rupees SIP will give you more units. So as markets fall, your units go up. Second, and which is a more important behavioral nudge, is that when you start a SIP at all-time high and when you see your initial returns are less meaningful or they are negative, first installment, second installment, third installment, uh, it tends to lower your return expectation versus investing, let's say, during a COVID low or a market crash. Your initial few installments, initial few SIP purchases gives you great returns, 10%, 20%, and investors start believing that that is the kind of return to expect, right? And more often than not, when returns don't come, they retreat. But when you start at lifetime high, initial experiences that returns are negative or very low, and you wait for returns to improve. Meanwhile, your units gets accumulated over time, right? So very, very important aspect. In the current scheme of things, the best strategy uh, could be don't do anything. But we believe that a better strategy than even not doing anything is starting a SIP, because it has shown historically with data that you end up making better returns starting a SIP at lifetime high. So that is, I think, the best way to participate in the market as things stand today, given the last two slides I showed you. Third is we have to respect the quality aspect in small caps, because small caps are prone to accidents. Many of these smaller companies find it very hard to navigate challenges because they have smaller revenue streams. They have very low profitability sometimes in absolute terms, right? Many of these companies could also be starting new. They have lesser operating history. So some of them may find it very hard to navigate bad business cycles, right? So therefore, there are a lot of accidents in this category. And secondly, also many larger companies who uh, go out of favor or they lose their business potential, or their managements do not carry forward great business practices, they also become small cap over time. So there are many ways and means where accidents can occur in this category. If you look at the data on your screen, we looked at two universe. So quality index universe, where all the stocks which were part of Nifty small cap 250 quality 50 index, since the data is available from NSE. So there were 222 stocks. And then we looked at the rest of the universe, all stocks which have been part of Nifty small cap 250 index, right? So which is the non-quality aspect, X of quality. We remove the quality names from this bucket, right? So X of quality. As you can see, there are 16% chances that non-quality or X of quality companies can erode capital. What does erode capital means? Falling more than 80-90%, right? Which means that you have a very large loss of capital. Many of these companies can also get delisted, or their share prices can fall more than 99%, right? But in case of the quality bucket, the accidents are very low, only 2%, right? So there is an 8 times larger possibility of having a bad experience or getting your capital eroded if you don't solve for quality. And we've seen that small cap universe is very attractive and returns are very high. For example, this year, last 6 months, returns in small caps are more than 50% on the index itself, which are very, very high. And this attracts a lot of people. They go all in and end up buying companies which have shown great promise only recently. Even today, when you look at the small cap universe, you can have a number of companies where profits and revenues have not grown for five years, but stock prices are up 2 to 3 times in last 6 months. So there is a lot of gray area where prices have run up too much too fast. Solving for quality can save you from some of these accidents. Maybe not all, but many of these accidents you can save your capital from getting through that bad experience if you solve for quality. How do you solve for quality? Picking up a quality index or picking up an active fund which is focused on quality aspect of investing, right? And we've highlighted some numbers here that how do you solve for quality? You look at three things. High ROEs, return on equity for the companies are high. Debt to equity, that means the companies have not borrowed a lot of money. Third, their variability is low. That means the profits that they make do not vary a lot. That what does profit variability mean? In 1 year, it is making, let's say, 20 crores of profit. In second year, it is making 40 crores. In third year, it is making a loss of 10 crores. So this is a very high variability of earnings or profits. Many companies who don't show very high variability, they have steady profit growth over time or steady profits. They usually follow the quality, they fall in the quality bucket, right? So these are few aspects that you should keep in mind. Just to recap this section, one, we think that small and mid cap universe is slightly frothy. There could be an underperformance versus large cap. And let me also insert a point. The corollary may or may not be true. That means if small and mid caps can underperform, it does not mean that large cap will give you very large absolute returns, right? Maybe it is a better place to stay versus the small and mid cap stocks, but we have to solve for valuation even in large caps. Second is how to invest in small cap at this time. As I said, SIP is the best route. At all-time high, it can give you better experience by improving your return profile over time, both behaviorally and also because of accumulation of units. Third is pay a lot of focus on quality in small caps, because this is a place where a lot of accidents happen and quality can help you avoid those accidents. The second section, which I think is very, very important, is how fast is India growing? And this is a debate and numbers that we keep on hearing online through a lot of mediums. A lot of economists and strategists keep on giving their own outlook and when will we reach 10 trillion GDP or 20 trillion or 5 trillion, right? So there are a lot of numbers floating around. So we said, let's look at the past. What have we done in the past? So we looked at Indian GDP data. We took it from 1980 and we took 5-year CAGR for India's dollar GDP growth. Okay, these blue bars, they represent 5-year CAGR for India's dollar GDP, which means that the current GDP for India is around $3.5 trillion. So this is the CAGR of that number. As you can see, over the last 37 to 40 years, we have grown at 7.3% CAGR on average. This is our long-term growth rate. And if you look at this period, which is from 2002 to 2011, this is the only period where our growth rate is extremely superior. It was about 13.2% on average. Very strong growth rate. But surprisingly, we have not exceeded our average growth rate for a prolonged period beyond this point, right? Beyond this cycle, we have not really exceeded our growth rate. In fact, if you look at a period from post 1991, the average will be slightly higher, about 7.5%. So this is a long-term growth rate number. Now the question is, can we grow at whatever 10%, 12%? A lot of people are talking about 15, 16% growth rate, right? In terms of dollar GDP. Now, the data clearly suggests that 7.3% is our long-term number, right? Let's look at mathematically, if we grow at our historical growth rate, which is 7.3%, where will we reach? So currently we are $3.5 trillion economy, right? The rule of 72 says that if you grow at 7.2%, you double in 10 years. Simple maths, right? Which means that 3.5 trillion will become 7 trillion in 10 years. So 2033 or 2032, given that we grow at 7.3, we'll reach $7 trillion GDP, right? So we hear a lot of estimates saying that we will become 7 trillion in 28 or 10 trillion in 30 or 32 or 35. You can see how hard it will be mathematically to reach those numbers, right? For that, we need to quicken our pace, grow at 10% plus, 10 to 12% plus. And as you can see, historically, we have done that only during the period which I showed you, only during this period. And what was so special about this period? Why did we grow so fast? Because the world was also growing very fast. In this phase, the world nominal GDP growth rate was 7% plus. On the longer horizon, it is only 5.5%, right? Is the globe growing at 7.5% today? The answer is no. Do we have the global, tailwinds that we had in 2002 to 2011? The answer is no, right? We don't have those tailwinds. So, it will be harder for us to grow at 10, 11, 12%. B, many of the ingredients required to grow at 10, 11% is currently absent. So there are only a few countries who have done this kind of a growth rate. Some Asian tigers, China, of course, has done this. They had a very large manufacturing share, very large, current account surpluses running and supporting them. We don't have either of them. And that could be a headwind for us to grow faster. But a 7.5% growth itself is a very strong number. 7.3% is a very strong number. Now, the point is how to think about this in terms of investments, right? Because this is all theory and economics doesn't even matter. So I'll try to put these numbers into perspective on how to look at these numbers from investment perspective. So look at Nifty 50. Next year in 2024, I don't know which month, but the EPS will become 1,000 rupees. Right now we are at 927 or 920. We'll add 80 rupees easily over the next 12 months. When we will add, nobody knows, right? Maybe early or late, but in somewhere in 24, Nifty EPS will become 1,000 rupees, right? So same if our GDP is doubling in 10 years, most likely let's assume that Nifty EPS will also double, right? It's an assumption, right? It may or may not. So Nifty EPS will also go to 2,000 rupees. But the numbers that I showed you are dollar, adjusted for dollar. So you have to add domestic inflation on top of it because earnings grow nominally, right? So if you add back RBI's midpoint, which is 4% or let's say 4.5%, 5% inflation, you will grow at between 11 to 12%. So let's assume you grow at 11% or so. The 1,000 rupee, which I was saying will become 2,000, will actually become 2,500, right? So 2,500 of EPS for Nifty. So if you now multiply it with a PE multiple, what is the PE multiple that we should multiply it with? So if you were sitting in 2000 to 2010 decade, our average PE multiple was 17 and a half, right? Which was also the biggest bull market that India has ever seen, right? That was our average PE multiple. So if you multiply with that number, we will get 45,000, right? Right now we are at 21,000. What is the CAGR return that we'll get? So we will roughly double, right, over a 10-year period, right? So roughly the CAGR returns will be less than around 8.5%. Not very high, right? So even if you take this number and say that we will be priced at 20 times earnings, right? Which is the new average that we have now, which people believe that this is our long-term average, which of course it is not. But let's assume that market gives a PE multiple of 20 times. So 2,500 into 20, 50,000. Again, a growth rate of less than 10% or so, 9.5% CAGR. This is the equity return basis our own historical growth rate. If we better this growth rate by 1 or 2%, it will get added to our returns if our multiples remain where they are and the earnings are, the economic growth is translated completely into earnings. These are very, very big assumptions. They have not been true in many countries globally. We've seen that multiples change. Sometimes market equities, they give it 20 times multiple. Sometimes it gives it 15 times. Nobody can predict what the multiple will be, right? So we don't know what will be the exit multiple. And in many cases, earnings growth does not follow GDP growth. There are many phases, right? Even in case of India, between 2014 to 19, our earnings growth, or 2014 to 18, our Nifty earning growth was only 4%, right? While GDP growth was much higher. So these are phases, and we don't know what phase will be there in the future. What is the conclusion? The conclusion is that if the entry point for equity investor is cheaper, right, which means that you are not overpaying when you buy equities, your returns will be better. If you overpay, that means if you buy at 23, 24 times P multiple, then over a longer period, even if the economy does something extraordinary, your returns will only be very, very ordinary. So that is one of the most important point. And second is that we should not get blinded by numbers that we'll reach 10 trillion in XYZ year. We can do that maths and see where we are today. What will it take to grow by that number? If we see those ingredients coming together, maybe we'll try and highlight those ingredients in the next few editions of our report. What are those ingredients which can allow us to grow faster? Then possibly we can make that assumption. Until now, I think on averages, we are still far behind for reaching 10 trillion. Maybe by 35, 36 or later, it's quite possible, given our growth rate continues to be that way and the world economy continues to support India's growth, right? So this is the conclusion from this slide. Second is there is also an assumption and expectation in the market that India is garnering a lot of flows that are not going to China. So in China, a lot of FIs and FDI flow, which was there for a very long period of time, has more or less dried up, right? They are not receiving a lot of flows. Specifically in FDI, we've seen that their quarterly flows became negative for the first time. China saw an outflow since the data is available. Data is published since 1998. So, which is about 25 years, first time quarterly China saw an outflow. And a lot of people believe that FDI is flowing into India. For now, we haven't seen that, right? We think that all the conditions are conducive for us to receive that FDI. But as of now, it hasn't happened, right? So we would want to see this number go up. In fact, India also saw a negative quarter in terms of FDI flows. And we would want this number to go higher to see that hypothesis play out, right? In fact, even in FII flows, a lot of people believe that India is getting a lot of foreign inflows. But when you look at the total number, they are very small. In fact, from the year 21, 22, 23, if you take all the years put together, and if you remove Reliance Industries' 2 deals, FI flows in India are negative, right? So in totality, in absolute terms. So that means if FI flow has to move out of China or other countries and move into India, that number should become positive and become much larger. And we believe that it can happen because Indian companies have shown profitable growth over time. India has the vibrancy in terms of corporate structure being much more favorable, but until now we haven't seen that happen. Once it starts appearing in data, it will become practical. Currently, it is just a theory, right? One important positive aspect that we are seeing is that outward FDI from India has slowed down. That means Indian capital is remaining domestically here, resident only in India, and maybe is getting invested in India. Earlier, a large part of our capital was flowing out in terms of outward FDI. It has many levers, right? It is not a simple point that Indians have started investing outside, because it has remittances, it has equity earnings, etc., which flow outside in terms of FDI. But a large part of it is also capital which was flowing out. That number has gone down, which is a big positive point, which means that risk capital, investment capital is getting invested domestically, which is a first right step. But are we getting very large foreign inflows? Currently, the answer is no. Can we get them in the future? That is the hope and expectation. We'll be happy to see those numbers materialize. Third is, as I said in the one slide before, that globally things are slowing down, and the background, which was favorable background, which was present in 2002 to 11, is not present as of now. And you can see that this table shows you PMI readings for many countries. You can see in most developed countries, the readings are below 50. The most recent readings. Readings below 50 means that the manufacturing sector in these countries is contracting, degrowing. You can see there are very few countries where it is above 50. India is strongly above 50, which is showing a very strong growth rate. There is Philippines here and Singapore and Indonesia. Singapore is a very volatile number, so you can ignore it. But Indonesia, Philippines, India, they are showing better trends. China itself is negative right now, right? So most countries, and the readings which came for November, for all of them are lower than they were in October. So global growth is slowing down. And interestingly, if you read the most recent RBI monetary policy report, the outlook starts by saying that global growth is slowing, and which is what the RBI is also looking at very closely. So we are also looking at this number closely, because unstable globe does not favor India's growth also, right? It might look like that we are outpacing, or we are the fastest growing economy, and therefore we are decoupled or delinked, and we don't have any linkages with global growth. Historically, that has not been the case. A favorable global growth is much more beneficial for India than a more distorted global growth picture, even if it is China, right? So a growing China is more beneficial for India. It sounds counterintuitive, but that is true. Now we'll talk about a few ideas, and maybe let me recap the last three slides which I spoke about growth. So one is we should look at our historical growth numbers and think about what is needed more to catch up on these numbers. Do we have those ingredients? As of now, we don't have many tailwinds coming in from globe or domestic. We have improved our growth numbers, but we are still below our own average from a longer term perspective. And also maybe one point which I missed making earlier, the size of Indian GDP is now much larger. So to grow at 14-15% when you are $1 trillion versus to grow at 15% when you are $3.5 trillion is very difficult. It's very different, right? So this also we have to take into account. Second is that the expectation that India will receive a lot of FI flows, FDI flows has not come up in data. We hope it will come up in the future. As of now, it is missing, but we'll continue to watch this data carefully. Positive aspect which I noted here is that outward FDI has slowed down, right? Third is global growth is slowing down. Most data points that you watch globally are indicating that economic growth sequentially is coming down. It takes time, right? A lot of people believe that it will slow down intraday or intra-week or intra-month, but economic changes take a very long time to happen. It happens slowly and then suddenly. Right now, we are in a gradual phase. So these numbers slow down very gradually over quarters, right? So right now, we are seeing that slowdown happen, which is also point of concern for India, because India benefits when the global growth is strong. Third and last section is on ideas, where we think that there is a lot of chatter about unorganized sector making a comeback. And we've seen that many data points published by listed FMCG companies indicate, or their commentary indicates, that things are improving, right? But when we look at hard data like labor intensive and non-labor intensive IIP numbers, or we look at rural wage growth versus corporate India wage growth, or we look at the Nielsen tracker for FMCG volume growth, we are not able to see this in data. So it is absent in data, although it has started to appear in some narratives and management commentary, and therefore it has made us more interested in tracking this more closely. As of now, it remains absent from data, but it can be a big trigger, right? Because this is a very, very important sector. And in our DSP transcript, we have dedicated one full section of what companies are saying. So I think this is possibly a time where it could shift, where rural economy or unorganized sector can see some recovery, but it is just still a conjuncture. It has not appeared in data, and we'll be looking at this data more clearly because some managements which are important and large have started to talk about it. The next is the auto sector, where we think that a big transition is happening from traditional IC engine to EVs, and demand is also coming back. But still, the CAGR numbers are very, very slow, very small. We are far, far away from our breakneck growth speed. Maybe in two-wheelers, it is going to be very hard. But for many other sections of this sector, there can be a big catch-up, right? So we remain quite positive on this sector, but valuations have to be, taken into account. Some of the segments in this sections have run up, but we still believe that in the next 3 to 5 years, including healthcare and banking, this is another sector which could throw up a lot of opportunities. In fact, if you look at the consumption of petroleum products, which is in volume terms, is also increasing now at 2% CAGR. Our best growth was 4% CAGR. We are coming back to stronger growth rate numbers. This could again be a very, very beneficial story. It could also play out in OMCs, oil marketing companies. So this is something which we think is headed in the right direction. It will be volatile. We'll have to watch valuations, but this is one sector which looks promising. Healthcare again is a sector which we've been talking about for last year and more, and now we see that all three segments, pharma, path labs, and hospital, it has started to print very, very good numbers. And earnings have grown in this sector. Margin of safety continues to remain high. This is also sort of a quasi-defensive sector because of the valuation it provides and non-linkage to economy that it has. So we believe healthcare continues to be a very good theme. Over the next 3 to 5 years, we believe that profitability in this sector could be handsome, and our focus will continue to be here. For US equity, we believe markets are diverging. We have seen that stock prices are still headed higher, very close to all-time high, but Fed balance sheets is now $1.2 trillion lower. It's going down where they are doing quantitative tightening, and economic data is also deteriorating. So we believe that this divergence may not last for a very long time, and US equities could also erase the gains that we've seen more recently. So plus I showed you that how global growth is also slowing down. So eventually equities can correct even in US. They have not done that over the last 2-3 months, but we believe they continue to remain very pricey and prone to a correction. This is putting two markets in perspective, one US market and the other Indian market. As you can see, both have done the opposite, right? If you look at the top panel, it shows you the US market and how it has moved. The Magnificent Seven, the large cap 7 tech companies in US, you can see since COVID, they are up 4 times, right? And over the last 1 year, they are up. They are up from 200 to 400, right? They are up 100%. But the broader market, the small caps and mid caps, they are flattish over the last 12 months, not done much, right? In case of India, it is the opposite. The small and mid caps have outpaced large caps by a very, very wide margin. And that has happened more recently. So two markets which are performing well, both doing the opposite. The complexion is completely opposite. But when you look at the numbers are more aligned. In US, these companies are the ones which have reported very strong profitable growth and therefore are being rewarded significantly. Domestically also, small and mid caps are much more cheaper when we began the year, which we also highlighted earlier, and they got that benefit, right? From here, I think on both the panel, the trajectory will depend on earnings growth, which is dependent on economic growth, because all other levers are not present now in terms of margin expansion, and therefore we believe that both the markets are at the mercy of how the economy performs. Currently, the signs are it is slowing down. So both these panels, US or Indian market, will face some resistance, some headwinds from slowing down of earnings growth, and therefore we believe that it's the time to be more conservative in your approach when approaching equity valuations. So one last slide, which is just a visual representation that 40% of world is going to vote in the next 12 months, and a lot of political promises will be made globally. And usually we've seen that it is a source of volatility. We have no idea what will be the outcome in various countries. Neither we have the expertise to predict it or domestically. Only point is that stock prices are not so volatile. Nifty implied volatility is at the lowest level that we've seen in 15, 16 years. This is an event which creates volatility. It creates uncertainty, and that can, result into very high options premium or market adjusting to this new reality, right? So we need to be wary of very low volatility. It is also a source of risk, which also shows that markets are more complacent to the upcoming events than they should be, right? So this is it from my end. The last is a behavioral slide that we usually put, which is a more visual representation that if we continue to adopt investing discipline, which means that not overpaying and continuing to invest in good quality names over time, our investment experience could be much more superior than what it was in the past.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.